Now,
Should we start off now?
yes, sir. Please.
Huh?
Please, sir.
Acha.
Now the 102 students, participants are joining. Still now they are joining.
Huh. But we can start now, I think, no? We have waited almost 10
Yeah,
minutes.
and we already have more than 100 participants here. So
Okay.
let's please start.
Okay. Yeah, good afternoon to all of you. In the morning, we had a session on how to read a balance sheet. This was a very important prerequisite for going forward into the understanding of fundamental analysis of stocks. Because you are going to analyze financial statements later on, and a basic understanding of balance sheet, profit and loss statement, and the relevant ratios is critical to working out what is called the intrinsic value of the share. We will discuss how to estimate the intrinsic value of the share in the session, in the second part of the session in the afternoon. So first, let us go to the basics of fundamental analysis. As you have seen, I am very fond of quoting Warren Buffett. who, as you know, is one of the in the top 5 richest men in the world and considered to be a guru in uh, in value investing. And that is what we are all going to discuss: value investing and understanding the intrinsic value of stocks. So Warren Buffett says that never invest in a business you cannot understand or you do not understand. So many of us, start investing in stocks based on some tips which have been received from some friend, relative, or some broker. Okay, it is a very common practice because we ourselves don't understand, so we depend on others to give us a hint of where to invest. But Warren Buffett says very clearly, never invest in a business you cannot understand. And our whole purpose of this afternoon session will be try to get an understanding of the basic issues before you invest in a business. Okay. The other part of any investment is risk. In the morning session, you heard Joel Panikot of CMT talk about it. You heard President Sir talk about it. Professor Anupam also talked about it. You see, investment and risk go hand in hand. Okay. And you cannot have an investment without assessing the risk in that investment. And as Warren Buffett again says, risk comes from not knowing what you are doing. Okay. So if you blindly go ahead and invest somewhere without understanding the business, there is a lot of risk. You don't know what is going to happen. You have just taken a chance. But if you have studied that company, understood what makes that company tick, where the dangers can come from, then to that extent, the risk of that investment is at least minimized, or you are conscious about the risk which you are taking. Okay, it is not a blind risk, but you are conscious of the risk you are taking. So it's a very important saying here: risk comes from not knowing what you are doing. So let us, in this afternoon session, know what we are doing. Okay. Coming to another quotation of Buffett, all of which are so relevant in our discussion this afternoon. Only buy something that you would be perfectly happy to hold if the market shut down for 10 years. Now, see, what is he trying to say? He says, by this, what he's trying to say is that invest in something which will not go away. Tomorrow, suddenly you will not find that the company has disappeared, or that technology has become obsolete, or the products are no longer required by the customer. You buy something that you'd be perfectly happy to hold, even if the market shut down for 10 years. Okay. So look for such stocks. And I will give you some examples from my personal life also. Okay. Here is another great anecdote. Warren Buffett's biggest mistake. In the 1960s, Warren Buffett spent $4 million to buy a 5% stake in Disney. He sold that stake for $6 million, a 50% gain. He's called it one of the biggest mistakes of omission. That position, had he held it, that 5% stake, had he held it, would be worth $8.7 billion. If he had held on, and if he had not been in a hurry to sell, because he had made a 50% profit, and if he had held on to that position, he would be today holding that 5% shares of Disney would be worth $8.7 billion. 1,000 million makes 1 billion. So you can understand what figure we are talking about. Okay. So the lesson from here is that if you have selected the stock after proper analysis, okay, stick on with it. Don't be in a hurry to leave, because it will give you value. It will give you value in the long run. Okay. So you must not become too impatient. It is important. From my own life, I will give you my own example here at this stage before I go into this. See, I had my first investment in share market was buying the shares of Housing Development Finance Corporation Limited. I'm not talking about HDFC Bank. I'm talking about the parent, Housing Development Finance Corporation Limited, which in the year 1973-74, I forget whether it is 1974 or 73, 1974 most probably. Okay, it came out with its first public issue, initial public offer, and the share face value of the share was 100 rupees. And uh, you see, what was my concern? I applied for 20 shares. Face value was 100 rupees. Okay, so I applied for 20 shares. So 20 shares value was 2000 rupees, which was a very big amount for me in those days, because I had just joined a company which happened to be Larsen and Toubro at that time, just out of college. My salary was also not all that much. So whatever little savings I had, maybe in the course of a year or so, I said 2000 rupees, I can apply for 20 shares in Housing Development Finance Corporation. And what was my objective? My objective was that in the next 3-4 years time, I should be able to have my own place to stay in Mumbai. I was staying at that time with relatives. So I said that if I have to continue in Mumbai, I must have a place of my own to stay. So what is the best thing to do is to probably buy a flat, maybe a one bedroom kitchen flat, 1 BHK flat, 600 square feet or whatever it is. Okay, so and that kind of money I got some support from my father, but I was looking for borrowing some money from any finance corporation which could give me a housing loan. And it was at that time that Housing Development Finance Corporation came into the market with their initial public offer, first offer of shares to the public. So I participated in that offer, because if I became a shareholder, I would get a 1% reduction in the interest to be paid on a housing loan, which I might take in the future from HDFC Limited. So because I wanted to have a roof over my head, because I was looking for financing which I could afford, and here they was giving a 1% discount on the loan interest rate. So I applied for, and I got allotment of 20 shares. Okay. Now at 2000 rupees, right? Now over the period of years, and I'm holding those shares today, 74, and today we are in 2021. I'm holding those shares. That 2000 rupees has become more than 2 crores of rupees. 100 face value, 100 rupees per share. Today they have split the share. It is now, I think, 2 rupees face value. The market price of a HDFC share, I think, is more than 2000 rupees. I don't have the exact figure.
2500.
2500. Okay. And over a period of time, they issued bonus shares. Okay. So with all that thing happening, all that bonus shares means, those of you who do not know, if I have 10 shares, let us say, and there is a 1-for-1 bonus, it means I get 10 shares free from the company. Okay. So without any cost to me. Right? So with all that happening, that 2000 rupees is worth more than 2 crore of rupees today, and I'm holding those HDFC shares, which was my first investment in the stock market. So I can very well understand when Buffett says that was his biggest mistake. Okay. Similarly, I would strongly commend to those of you who are listening to me that identify such stocks which will not go away. Housing Development Finance Corporation will not go away. Housing is a critical issue in this country. It is always going to be needed. Irrespective of what happens, housing will always be needed. There is a growing population. More and more families are becoming nuclear families. So the demand for housing is constantly growing. It's not going to go away anywhere. So whether you are talking now, or as I am talking to you after 40 years, or some of you will be talking to your children after another 30, 40 years, housing requirement will always be there. Okay. So if some of you would like to investigate the HDFC Limited stock, you are welcome to do that and find out its intrinsic value and see whether it makes sense for you to invest in HDFC Limited shares. Okay, so I'm trying to put you in the mood for fundamental analysis. Okay, now to do fundamental analysis, you have to start with the top analysis of the economy. In other words, you must understand the global environment, the domestic environment in which business is functioning. All businesses are functioning. Then you must have a look at the particular sector in which you are looking for a company. So in the case of HDFC Limited, the sector was the housing infrastructure sector. Okay, and then having looked at that sector, that it is a sector which is doing well, which will continue to prosper in this country, then you try to identify possible companies in that sector. And having identified, made a short list of the companies in the sector, then you pick up each of these companies and do a kind of a financial analysis of each company. And when you are doing that financial analysis, you will take recourse to some of the concepts and ratios and all, which we talked about in the morning session. And after you have looked at those financial things and all, and satisfies yourself that yes, things seem to be okay, then you have to value the share. And that is what we call intrinsic valuation. Okay. What is the value? What is the worth of the share? What is the truly the worth of the share? You want to make an assessment of that. So fundamental analysis, therefore, as you can see in this inverted pyramid, it starts with an analysis of economy, analysis of the industrial sector in which your company is located. It is analysis of that particular company in financial terms and non-financial terms also, which are equally important, which we shall talk about later on. And then you are valuing that share. Okay, what is the intrinsic value of that share? Okay, so it involves put it in a slightly graphical format, schematic format. It includes analysis of the business concept. What is the business model of the company? How is the company trying to make profit? How is it trying to make money? What is the business model of the company? Okay, you study the management of the company. You study what are the competitive scenario for that company, examination of the demand and supply situation for that company, and then you analyze the financial statements and reports of that company. So all this goes into just now what we talked about in the inverted pyramid also. These are all contained in that inverted pyramid. So what is fundamental analysis? Fundamental analysis is a method of measuring a security's intrinsic value. Intrinsic value. That means the genuine value, the deep-rooted value, the inherent value, by examining related economic, industrial, and company factors, including analysis of the company's financial statements. The end goal is to arrive at a number that an investor can compare with the security's current price in order to see whether the security is undervalued or overvalued. So the whole purpose, end result of this fundamental analysis will be to arrive at a intrinsic value, and then you compare that intrinsic value with the current market price and to see whether that share is overvalued or undervalued as compared to the intrinsic value. And depending upon whether it is overvalued or undervalued, you take a decision to buy or sell the share. If you are holding the share, to sell the share. If you are not having the share, to buy the share. So this is the whole purpose and end result of fundamental analysis. Okay. And when we are talking about doing this, we are looking for stocks which you are going to invest in for the medium or long term. Okay. The same analysis can very well be extended to even your investment in shares for the short term, because you are taking if it is a short term thing and you want to do trading, at least you are aware what is the kind of risks which you are running in trading in a share which is fundamentally strong. So if a share is fundamentally strong, it cannot give you too much of a loss. Even if you would get a loss, the loss cannot be too much because the share is fundamentally strong. But fundamental analysis is basically to guide you in the selection of stocks in which you can remain invested for the medium and long term. Okay. So as I have just now said, the earning prospects of a firm are linked to the prospects of the industry to which it belongs, which in turn is influenced by the developments in the macroeconomy. So fundamental analysis appraises the intrinsic value of the share through economic analysis, industry analysis, and company analysis. We will take a look at each of these types of analysis in the subsequent discussion. So, economic analysis. The level of economic activity has an impact on investment in many ways. If the economy grows rapidly, industry can also be expected to show rapid growth or vice versa. Economic activity affects industry sectors and firms in those sectors differently in terms of demand and supply of goods and services. So obviously, if there is economic activity is there, growth is taking place, then different sectors get impacted differently. Okay, there may be one kind of impact on the housing sector, there can be another type of impact on the pharmaceutical sector or on the transportation sector. So depending upon how the economy is growing, different sectors will have different growth rates and will be impacted differently. Correspondingly, this also affects the behavior of firm specific stock prices. Okay. The global economy also has a bearing on a firm's export prospects and the competition from international firms. So you cannot remain confined only to the domestic economy. You must extend it and broaden it basis to the global economy as well. Because today everything is interlinked. Central government policies impact demand and supply side of the economy. Yeah, government policies impact the demand and supply side of the economy. Fiscal and monetary policies and budgets are the tools for economic management. Why do people, eagerly wait for the budget? Because the budget every year gives an indication of what the priorities of the government are, where the government is going to spend the money, and depending upon the way it is spending the money, there will be corresponding impact on the demand for goods and services in the economy. Likewise, are there any proposals for changing the taxes, direct taxes or indirect taxes, which will again affect firms across the board? Okay. Supply side policies includes tax policy to encourage investment and strengthen incentives to work, focuses on creating an environment which increases the productive potential of the economy. And these policies and budgets impact different industry sectors and the firms in them differently. So when you are, doing this fundamental analysis, what are some of the key parameters, economic parameters, which you will take into account? Okay. Other than the general scene which is there, the general mood which is there, as you can say, the general degree of confidence which may be there in the economy, you look specifically at some of the parameters which define the economy, which are GDP growth, growth in the gross domestic product, growth in industrial output, savings and investment rates. Okay, the more people save, the more likelihood of investments, and more investments mean more jobs, more products, goods and services produced. Okay, more such goods and produced are sold, the more there is profits and there is more money going around. You look at the inflation rate, because the inflation rate affects the purchasing power of the people. And anything which erodes the purchasing power of the people has an effect on the demand side as well, because there is less purchasing power means less demand. Interest rates charged by banks, if the interest rates go up, then people are reluctant to borrow. If people are reluctant to borrow, it means they are reluctant to borrow money and invest it in the business. Okay, so as a consequence, the investment growth may slow down. The growth of companies may slow down because they are reluctant to borrow money at a higher rate of interest. Okay, But if you keep the rate of interest low, people are more attracted and induced to borrow that money and put it into productive use, expand capacity, and so on, create new factories. So it helps to boost the investment cycle in the economy by keeping the interest rates low. Okay. Government budget proposals, as I mentioned earlier, budget proposals are very important because they are a part of the supply side and management of the economy, and also in terms of the demand side, in terms of taxation policies. Fiscal deficit and borrowings of central government. For this fiscal deficit is nothing but the difference between what the government, central government, brings in as revenue and what the central government spends as an outflow. So the difference between what is an inflow to the government and outflow from the government is the fiscal deficit. Okay. And if the inflow to the government is lower than what it is proposing to spend, that deficit has to be filled. From where the government will fill the deficit? It has to then borrow. From whom it will borrow? It will borrow from the central bank, it will borrow from the commercial banks, it will borrow from the public. So the government will borrow in order to fill the difference between inflow and outflow. Okay. So the more the government borrows, the more the fiscal deficit, the chances are that this will lead to price pressures. This will lead to inflation. Okay. So there is a limit to how much the government can borrow, because the more the borrowings, the more the impact on inflation, more likelihood of inflationary pressures. Okay. Which is not a good thing, because the more the inflationary pressures, less is the purchasing power of people, and the less people will buy goods and services, and in turn what will happen, that the industries and the agencies which are producing those goods and services will not produce so much of goods and services, and there will be a downward spiral in the economy. The growth of the economy will slow down. So these are all interrelated factors, which is a part of the climate in which industry functions and which the companies function. So we have to have an understanding of this environment. Okay, this macro environment, as we call it, the macro environment. Okay. Now, so these are some of the other parameters. Tax structure we looked at, balance of payment and foreign exchange reserves, trends in exchange rate, inflows of foreign direct investment and foreign portfolio investment, agricultural output, forecasts on the monsoon are very, very important. Demographic factors, the breakup of the population into different categories, investment in infrastructure facilities. Now, these are all, it is not an exhaustive list, but it gives you an indication of the parameters which you must look at in order to assess whether the macro economy is going to be favorable for your industrial sector and whether it is going to be favorable for the company in which you are thinking of investing. So having looked at the macro economy, we now take a look at the sector in which your company is located, or the sector which you think is going to be very attractive, and therefore you would like to look at a company in that sector. So you are doing a industry sector analysis. Okay. The objective of this analysis is to assess the business prospects of various industry groupings. The aspects to be considered are sensitivity to the business cycle. Now we talk about each of this one by one. What is the sensitivity of that sector to the business cycle? Industry life cycle analysis, structure and characteristics of an industry, profit potential of industries. So let us look at each of these phrases one by one. Sensitivity to the business cycle. Okay. Now, this indicates that there are certain industries which are impacted by the ups and downs in the industry, and certain industries which are relatively less impacted by the ups and downs. Industries that sell necessities like food items, so FMCG companies, FMCG sector, or the pharma sector, or the personal care product sector, they are less sensitive to business conditions. Whereas automobiles, machine tools, transportation and shipping, information technology are most sensitive to business conditions, whether it be domestic or global. All of you will accept this, that doesn't matter what happens, I have to buy, let us say, food and necessities sector will be less impacted. Even if there's a downturn in the economy, the FMCG sector will be less impacted. And in the COVID situation, the pharma sector is doing so well. All items which are pharma or which is related to medicine or medicinal supplies, accessories anyway, they are doing a booming business. Okay, so depending upon the environment, different sectors are affected differently. Okay, automobiles. Initially, automobile sector was very badly affected by this COVID situation because of the lockdown, and there was no business being conducted. People were not having the funds, the purchasing power to go ahead and buy automobiles. Okay, so the automobile sector took a big hit. It is reviving, but it has taken a big hit. Okay. Likewise, the hotel sector has been very badly impacted, very badly affected, because the demand is simply not there. People are not traveling. Okay. So different sectors get impacted by the macroeconomic situation differently. So according to this, how sensitive it is to this cycle. So this is the business cycle, mind you. For example, I'll give you another example of this. Cement and steel. Cement and steel industries are cyclical in nature, because in any economy there is a boom period and there is a bust period. Okay, the economy booms for some time and then it goes into a slowing down for some time. Now, basic materials like cement and steel, which go into creating infrastructure in a country, okay, cement and steel are affected by this business cycle. So you'll find that when there are certain periods when the cement and in steel industries are growing, and which is linked to economic growth. But when the economy is slowing down, you'll find that means the growth rate of GDP is becoming less. Maybe from 8% it has become only 4%. You'll find that the demand for steel and cement is also becoming less. So it is your sensitivity to the business cycle, right? Industry life cycle analysis. The development of almost every industry may be analyzed in terms of a life cycle with stages such as, okay, so there is a pioneering stage of every industry, there is a stage of rapid growth, there is a period of maturity and stabilization, and then there's a period, or inevitably a period of decline. So if we are looking at a company which belongs to an industry which is in the maturity and stabilization stage, we cannot expect a kind of a fantastic growth rate. We cannot. For example, the FMCG industry is in a stage of maturity and stabilization. Maturity, let us say. Okay. The FMCG companies in the FMCG sector are unlikely to have fantastic growth. They will have growth, a reasonable growth, but nothing fantastic, because that sector is a mature sector. Right? However, you may have an industry which is in the rapid growth sector. Let us say rapid growth or pioneering sector. You take the example of the biotech industry, for instance. A biotech industry today is growing rapidly, very, very rapidly. Okay. So companies like Biocon, they have got enormous prospects of future growth. Long way to go. Right? So if you look for companies which are in the biotech sector, the chances are that you will be they will be in for a very good growth. However, you have to analyze the company to know whether you are investing in the right company in the biotech sector. You should not be investing in a poor company or a company which is not doing well, not well managed. So that will be a part of your fundamental analysis. Okay. So there is an industry life cycle which you then try to identify. In what kind of stage is the industry in for which you are trying to select the company. Structure and characteristics of an industry. Each industry is unique, and a systematic study of its specific features and characteristics must be an integral part of the investment decision process. Industry analysis should focus on structure in industry and nature of the competition. Sorry, I'm sorry. Structure. Uh, I'm sorry. Structure and characteristics of an industry is where you are looking at things like. I'm sorry, I went on to the second factor. You are looking at things like how many firms are there in that company, in that industry. How many are big firms? How many are small firms? Are there some firms which are dominant and the other firms are less dominant? Are all the firms of an equal are competing equally with each other? Okay, okay. So you are looking at therefore the makeup of that industry, big or small. How many are big? How many are small? Do they compete with each other equally, or there is a dominant leader and the other people are only followers? So what is the structure and characteristic of that industry? Next, you look at what is the structure of the industry and the nature of competition. So then you get a little more into the nature of the competitors who are functioning in that industry. Okay, who is very strong, who is weak, what is the unique selling proposition of the market leader, or if a smaller firm is now trying to come up and compete with the market leader, what are the basis on which it is competing with the market leader. So you take a look at the nature of the competition. What is the nature and prospects of demand? Is the demand continuing to grow? Is the demand is going to slow down? Is the products becoming obsolete? So you are looking therefore at that pattern of demand which is there in the industry at the present moment and what might happen in due course of time. Cost and efficiency. Cost and efficiency indicates whether the industry is working with latest technology. Is it working with new plant and machinery? Okay. Is it an industry where the workforce is quite aging and it is having skills which are getting more and more outdated, or it is up to date with the skills which are required for tomorrow? So so you are looking at the elements which make up the efficiency and productivity of that industry. Okay, what is happening in the industry from these points of view? And then, of course, you look at technological trends. The current technologies which are being used in that industry, are they going to be relevant for the next 5, 7, 8 years, or are those technologies are on their way out and new technologies will come in, and and we should be looking out for that. Okay, a great example of this, which I'm very fond of quoting, is that of Kodak. Kodak used to be a market leader in photographic films and cameras. Kodak was also the company which invented the first digital camera. And today Kodak is bankrupt. It became bankrupt quite a few years back. When I'm saying today, means quite a few years back, Kodak became bankrupt. Okay. Why it became bankrupt? Now, it is the inventor of the first digital camera. The digital camera which was carried by Armstrong on the moon, when he landed on the moon, was a camera made by Kodak company. But Kodak company disappeared. It is no longer no longer, forget about ordinary cameras. It is no longer even in digital cameras. Okay. Why? Because you see, it understood that a new technology has come, but that the new technology is so important and it will grow so fast. Okay, that it will make the traditional method of the printing and developing a film, the traditional cameras, it will become obsolete so quickly. It was not able to understand the trend, so it could not move into the digital space despite being the pioneer in the digital space. Okay, so that's what happened. So therefore it is important that if you are investing, in an industry, investing in companies in that industry, we understand what is the technological trends which are happening in that industry. Okay, should not invest in a stock of a company whose technology is going to be obsolete in the next 5 to 7 years, right? Okay, then finally we look at the profit potential of the industry. Is that industry an industry which is making money, or is the industry simply having average profits? Okay, nothing very great, nothing very great. Okay, so if that industry is not making very good profits, is not attractive enough, then why should we look at that industry? Why should we look at companies in that industry? The profit potential of that industry is not great, therefore let us not look at that industry. Okay. So that is something which you have to take into account. Now, so what we have said so far here is there is a macro environment, there is the industry environment, okay, and we are at a stage where we have identified we have now looked at some companies, we are now looking at some companies in certain industry areas, and we want to know whether it is worthwhile to invest in that company. Maybe we have selected a sector which is an attractive sector, and in that attractive sector there are 3 companies which we have just identified. I will not say we have shortlisted, we have identified which we are interested in. Now, I must understand whether I should invest in company A, or I should invest in company B, or I should invest in company C. Okay. So I have now come to the stage of company analysis. Okay. And to do this company analysis, I must understand the company. I must understand the company. Okay. What does it mean? I must understand its business model or the business strategy of the firm. How is the company doing the business? What is the strategy of the firm to make money? I must understand that business model of that company. I must understand the quality of the firm's accounting data. Okay. Is the data reliable? Okay. Are there certain hidden landmines in that data? Somebody was asking in the morning session, is it worthwhile to read Romancing the Balance Sheet? Yes, romancing the balance sheet. You can have a lot of romance, but end of the day, if you are there for the long haul, the romance will disappear. The honeymoon will be over, and you'll be left with the nitty-gritties of the marriage, that you have invested in a stock and the romance period is over. The company has made a fool of the investors, and tomorrow the promoters have disappeared. Okay, so it is very, very important to understand the quality of the firm's accounting data. Okay, and whether somebody is not trying to do something which will make a fool of the investors. We must understand the past financial performance of the firm. That is why we spend so much time trying to understand the balance sheet and profit and loss statement and the various ratios. Because the past performance of the firm will indicate 2 things. One thing, if it has been giving a very high return on investment, return on capital employed, it is an indication of the quality of the management. That means going forward, we can expect, that means the performance may be similar, if not better. That is one thing. Okay. And the second thing, the past performance will give us is an indication that some of these ratios, which we are going to use tomorrow, to use and find out the intrinsic value of the share, whether those ratios and parameters can be used in the future forecasts for the firm. Okay, so that is why the financial performance of the firm and analysis of that becomes important. And then last but not the least, in the company analysis, we have to look at certain vital non-financial aspects of the firm. As we have said in the balance sheet's limitation is it can reflect only those things which can be expressed in monetary terms. But those things which cannot be expressed in monetary terms are not there. And we need to know some of these things which are non-monetary in nature, but vital to the success of the company and vital to the intrinsic value of the share. Okay. So what does the business model mean? What does the business model mean? How the company is doing the business? Okay. How is it making money? What is the model for making the money? The profit potential of a firm is largely influenced by the industry in which it operates and by the strategy it follows to compete in its chosen industry. The strategy of the firm is to gain what is called a competitive advantage. What is it that I am doing better than my competitors? Or where I have got an advantage compared to my competitors? Okay, what is my USP? Okay, how do customers see us? Okay, what do customers think of my products? Do they think of my products as something superior than the products of my competitor? So where does my competitive advantage lie? It is very important to identify for a company which you are considering for fundamental analysis to understand where is the competitive advantage of that company. Where is it superior to the competitor? Okay, and where does that superiority fit into the strategy to make money in the company? So we say the uniqueness of a firm's core competencies, something it does better than anybody. Okay. And its value chain. The value chain is right from the purchase of the raw materials to selling the finished goods and servicing the finished goods. In that entire chain of activities, where do I do things more efficiently, more effectively than my competitors do? And therefore, where I add value to my final business. What is it that I'm doing better, more efficiently than my competitors, and I'm adding value to my business? So this entire value chain, from purchasing of raw materials to producing the goods to selling the goods, collecting the money to servicing the goods, this is my value chain. So if I do this more efficiently, more effectively, I will make more profit. And to the extent that it is difficult for competitors to imitate this value chain or imitate the core competencies which I have, to that extent, I have a competitive advantage. And the word which is used is sustainable competitive advantage. The competitive advantage is not for the coming year or for the next year. That is the competitive advantage which is sustainable. That means which will continue with me for the next 5, 6, 7, 8, 9 years. So that competitive advantage is a sustainable competitive advantage, not a flash in the pan. It is there today, tomorrow it disappears. No good. It is no good from the point of view of fundamental analysis and stock selection. I'm looking for sustainable competitive advantage. Right? Okay. Accounting analysis. Accounting analysis seeks to evaluate the extent to which the firm's accounting reports capture its business reality, whether it is following the institutional framework for financial reporting, and whether there is any distortion or bias in the accounting data. Yeah. See, all of us expect that companies will be following the regulations for doing their, financial audits, the regulations for accumulating the financial information in the way specified by the Institute of Chartered Accountants. But there is no guarantee that the companies are following them. There is no guarantee that the company is not in the hands of a promoter or a management team which is out to distort this information in some way and thereby fool the investing public into believing the company is doing well when the company is not doing well. You have to be alert. Yeah, you have to be alert. Right? Now, I will again talk to you from my own personal experience. I invested in a company um, uh, called Satyam Computers, and I invested in that company in sometime in the year uh, in the 80s. In No, not in the 80s. It is in the late 80s. I forget the exact year. In the late 80s. Now, if some of you remember Satyam Computers, I don't know. Satyam Computers was in the hand of a person called Ramalinga Raju, and this Ramalinga Raju was hailed as one of the entrepreneurs of the year. He was hailed as an entrepreneur of the year, and he took the company to great heights. Okay, and then one fine day, Ramalinga Raju came out with a disclosure, public statement that all these recent years I have been fooling you all. He came out with a statement, in black and white, saying, I have falsified the accounts. I have paid salaries to people who were not employees of the company. They were ghost employees. I have billed sales to customers who do not exist. You know, he came out with statements like this. And therefore, all the profits which I have declared, those are all false. Now the question came that how were those profit and loss statements and balance sheets audited by the auditors, and who were the auditors? The auditors were no other than Coopers, PwC, multinational firm, has audited the accounts, which were all false. The chairman of the company says they were all false figures, and the auditors have certified the accounts, PwC. This is not a story. This is the real incident which I'm telling you, because I happen to be a shareholder of that company. And I bought the shares in that company at 20 rupees a share. I saw the days when the share went up to almost 150 to 160 rupees a share. A 10 rupee share went up to 160 rupees a share. And then I saw the days when it became 2 rupees a share after these disclosures came out, and Ramalinga Raju was arrested. The managing partner who certified the accounts of Satyam Computers in PwC, he was arrested and he's still in jail, I think. Okay. So the share price came down to 2 rupees a share. The company was finally, taken, control of the company was taken over by the Ministry of Company Affairs, and they auctioned the company, and Tech Mahindra finally bought this company. So whatever shares I was holding in Satyam Computers is no longer shares in Satyam Computers. They were converted into shares of Tech Mahindra. So I'm holding Tech Mahindra shares today. Because when the share came down to 2 rupees per share, which I had bought for 20 rupees a share, I said, what is the good use? 2 rupees in 2 rupees, why just let us continue? It may even become 50 paise, who knows? But I can take that risk. Let it continue with 2 rupees. But finally, it got sold and converted and all. And today I'm holding Tech Mahindra shares in lieu of the Satyam Computer shares. But it is just to show you that just because you are looking at annual report, it has been certified by the auditors, it is no guarantee that things are hunky-dory. Okay. So you are looking for, are there any red flags? By red flags, I mean early warning signals. Are there qualifications in the audit reports? That means they have said that qualifications means the auditors themselves have indicated that, look, these are things which have happened and you need to know about it, be conscious about it. Are there unexplained changes in the accounting policies to cover poor performance, or there are transactions to inflate profits? Okay, just like I gave you the example of Satyam Computers, that means sales were booked to customers, non-existent customers. Okay, so there's no genuine sales. The sundry debtors were jacked up, but there were no debtors because they were all ghost debtors. And therefore, there was no money collected. So there was no cash flow in the company, really. Okay. So therefore, accounting analysis, looking at the annual report, the auditors, notes to the accounts, the auditors report are quite important. Financial, then having understood this financial analysis part, which is so very vital ultimately. It starts with a historical analysis of past financial data and uses this as a foundation for developing the forecasts required to estimate the intrinsic value. So that is why we are spending so much time on these ratios and these parameters. Annual reports, profit and loss statements, balance sheets, and fund flow cash flow statements are used for historical financial analysis. The key metrics analyzed in the financial analysis year-wise are, and these are some of the parameters which I showed you earlier in the how to read a balance sheet session. Okay, so this is only a endorsement or reinforcement of what we have talked earlier. So you have to look at what is the growth rate in the, what is the CAGR, compound annual growth rate. Because if you have a period of, let us say, 5 to 10 years over which you are analyzing the financial statements, you are not interested in the year-to-year growth, which might, some year may be small, some year it may be less, another year it may be fantastic. You are looking at an compound annual growth rate. 10th year is the terminal year, 5th year is the starting year. So if I was to make it a compound annual growth rate, what would it translate into? Okay, and that I do for sales, net profit, earnings per share, dividend per share, and all. I do that kind of a CAGR analysis. I hope you are understanding what is compound annual growth rate, where you are not looking at the year-to-year growth or decline. You take a initial period as your benchmark, you take the terminal period as your final position, and in this period, what is, if you were to annualize the growth rate in a compounded manner, what would be that compound growth rate be? Looking at the initial reference and the terminal year figure. Price earnings ratios, which we talked about earlier, price to book value ratio, dividend yield, return on equity, debt to equity ratio, interest coverage, all these things we looked at in the morning, and we are again repeating and recapitulating that these are very important parameters for your financial analysis of historical data. Okay, trend analysis in sales, net profit, profit before depreciation, amortization, interest, and taxes, and don't forget comparative analysis of financial ratios of competitors. Comparative analysis. So if you are doing it for the company you are interested in, develop these figures, ratios also for one of the important competitors and see how you stand relative to that competitor. Okay, that's important. So this is becomes a part of financial analysis. Okay, non-financial aspects. Okay, the analysis of the financial information must be supplemented with an appraisal of the firm's present situation, quality of its management, and future prospects. The specific aspects are cost advantage or disadvantages of firm vis-a-vis competitors, efficiency and effectiveness of operations. You are now looking at certain USPs. What is the USP of the firm? Okay, is it low cost? Is it something which is a differentiated product, a heavily differentiated product? Is it a very strong focus? So you are looking at what is the USP of the firm? Okay, how effective and efficient the operations are. Okay, so what makes that company different from the other companies? And you are looking at other than financial ratios or in a balance sheet or a profit and loss figure. Okay. Then you are looking at what are the demand for the products, firm's products and services. Is the demand strong? Is the demand going to be there after 5-7 years? Okay, or is the nature of demand changing? Okay, so therefore an understanding of the demand side is very, very important. Very, very important. Are the preferences of customers changing? Today I have one type of customer with whom I am doing very good business, but tomorrow the preferences of those customers might change. Okay. Then I look at the status of the firm's technological production and innovation capacity. Okay, is the technology which is the current and the future oriented technology? It is not obsolete technology, I hope. Are my production facilities modern and are they up to the mark? Or all my machines are very old, heavily depreciated? I have not automated. I have not gone in for using things like robotics and other things. No, so you look at the production capability of the firm, and you look at the innovative capabilities of the firm. This is very, very important. Is the firm which has been, basking in its old glory and it has now stopped innovating? Or is it a firm which is constantly innovating? Now, what happened in the case of Kodak? It was basking in its old glory. Okay, and it did not look at the new competitors, very, very small firms which were mushrooming everywhere and which were going forward at a very fast pace with the new digital camera, the new digital technology. And here was an elephant which was the pioneer in inventing digital camera, but which was lumbering along. It was too slow. It was too slow. Okay, and on top of that there was a baggage of the the chemical technology of for film production and cameras. That old baggage was still on its back. It had not shed the baggage and got out of it. Okay, so that kind of a thing is important to assess. What is the image of the firm in the marketplace? What do customers think about you? What is the company's exposure in the domestic and overseas markets? What is the status of human resources and personnel? Yes. Now, okay, romancing the balance sheet. So, if one of the ways to romance the balance sheet is to say that in the asset side of the balance sheet, I have the value of my human resources is so many crores. I have got top quality managerial personnel. I have got the most skilled workforce, and I am putting a value on that workforce and those human resources because they are assets. They are not financial assets, but they are productive assets. And if they are assets, I put a value on them, and I put that on the asset side of the balance sheet. Some would call it romancing the balance sheet. Some would call it, no, no, no. It is something which is to be taken note of. It is something we have to think of in future. Whatever be it, the fact remains that whether you put it in the balance sheet or don't put it in the balance sheet, the status of human resources and the quality of your managerial talent in the company, the skill sets of the labor force are very important considerations in looking at the company. Okay, very, very important. Yeah. Okay. So all of those people, who think that they have taken HR and they have made a mistake, and HR, they have no job prospects and all, please don't get so depressed. HR is a very vital function in industry, every industry. No doubt there are less job openings in this industry, but an assessment of the human resources and constantly getting it updated with training, development, and so on, and and appraisal of who the people, effective people are and contributors are, is a very vital part of the management of a company, and one has to pay attention to this part even when one is looking at the company from a fundamental analysis point of view. Then you look at what is the impact of regulatory framework on the firm's operations. Means the laws and practices of the land, to what extent they are impacting the functioning of the company. Quality of the management. Okay, the bottom line of the quality of management is the bottom line in your profit and loss statement. If a management is consistently giving you top class return on investment over the period of 5 to 7 years in the past, definitely it speaks a lot of the quality of the management. That is the bottom line. But having said about the bottom line, one has to look at whether the management is professional in nature. Does it take care of the requirements in needs of the investors or not? Is it following ethical practices or not? Is it the laws of corporate governance, are they being followed or not? Okay, or the management is out, somehow to try to feather its own nest. That means, in other words, trying to make money on the side, okay, at the cost of the investors. So you have to therefore look at these aspects of the management. What do people think about the management of that company? Okay, so very, very important, very, very important. Reputation of promoters. Yes, reputation of promoters. So here you had two brothers, Mukesh Ambani and Anil Ambani. Mukesh Ambani reputation, general feeling of people about Mukesh Ambani very high. General feeling, impression of the public about Anil Ambani not very high. What has happened to Anil Ambani? Anil Ambani has gone kaput. All his companies have disappeared or have been taken over. But Mukesh Ambani is going from strength to strength. Okay. So, I have given in a very, very sharp manner, I have tried to show you that how the two brothers are visualized differently by the public, by the invested public. Okay. So, what is the reputation, for example, of the promoters of Bharti Airtel? What is the reputation of Bharti Airtel promoters, for example, if you wanted to look at that way? Okay. Or you come to the two-wheeler industry. What is the reputation of the Bajaj family, which is running Bajaj Auto? What is the reputation of the, let us say, the Munjal family, which is running Hero Motors? So you try to understand that who the promoters are, of what kind they are, who the quality, who is the top management in the company, what is the quality of the top management, because that will determine how the company is being run. And obviously, the bottom line, as I said, is the continuously what is the dividends being paid to the shareholders, the capital appreciation, the increase in the share price, the return on net worth, return on investment. That is the bottom line, which shows you the quality of the management and the dedication of the promoters to the company. Finally, future prospects of the firm. Okay, so having seen all this, which is current, you have to think of what does the future hold for you. Okay, what does the future hold for you? Okay, you have to take into account. You have, for example, the example of the Nokia handset. Nokia was the number one handset company once upon a time. But then Nokia, as a number one handset company, went out of business. So what are the future prospects? Okay, that may be totally different from the historical information, from the past, the data. So if by through this analysis you are coming up with indications that the future is going to be different, and to that extent the historical data may not hold, okay, you have to make adjustments in making your forecasts. You cannot simply extrapolate the past performance into the future performance. The past performance will have to be modified in taking it forward. And to what extent it will have to be modified will have to be an informed judgment. There is no easy way out. There is no formula. There is no algorithm. Here, I don't know whether artificial intelligence can contribute anything here or not, but definitely it is something which is an informed judgment of how the forecast has to be made going forward. Okay. If things are going to change significantly. Okay. And just to give you a sense of what this means is that let me take the example of electric vehicles. Now, electric vehicles are coming in. They are already there. Tesla is already the number one manufacturer of electric vehicles. Okay. But what about General Motors? What about Volkswagen? What about Toyota? Where will they be in the future? If petrol and diesel cars are going to slowly go out, then where will Toyota and Volkswagen and General Motors be in the future? Because the future belongs to electric vehicles. So would the historical trends of the past from their balance sheets and profit and loss statement, will those trends hold? They may not hold. They may not hold. So we have to be therefore cautious in how we take this forward. Okay. So having analyzed the macro, the industry and the company information and the financials of the company and all, we are left with the task, and it is not an easy task, of determining what should be my intrinsic value of the share going forward. Going forward, Because if I'm going to invest and keep my investment there in the medium and long term, then I need to know what are the prospects of that company going forward, prospects in terms of profit, in terms of cash flows for the next 5 to 7 years. Okay. Okay. So just to summarize what we have discussed, I put it into one slide. So there is economic analysis, there is industry analysis, and there is company analysis. Okay, just eh, summarizing what I have already talked to you in the past almost practically 1 hour. That is what I have talked to you about. Okay, now we are ready to go into a separate set of slides, which is calculation of or estimation of the intrinsic value of the share. Having all this is all we are building up. This is the preamble, this is the prerequisites. Having done the prerequisites, now we are in a position to venture into how to estimate the intrinsic value of the share. Okay, so let us go to that. Just give me a couple of minutes to change my set of slides and we'll get into that. Okay, sorry, there are two more slides in that set. I missed out, and they are important. Okay, they are important. Okay, use the trends in the following ratios for initial screening of the firm. What I mean to say here is that in order to identify which company you should for which company you should work out the intrinsic value of the share, and you have identified maybe 3-4 firms in a particular industry, and you want to screen from those 3-4 firms. You want to identify one firm which you should now do the subsequent investigation, a subsequent estimation of the intrinsic value. So the initial screening of those 3-4 firms, which we will do, you will do with how we will do that. So in doing the screening, you look at these parameters which I have listed here: CAGR, P ratio, price to book value, dividend yield, debt equity ratio, current ratio. These are some of the parameters which can be used to use the initial screening of those 3-4 firms, to know whether you should continue with them or you should drop them or continue with one or two of them. So that screening, you can do it with using these parameters, right? Yeah. A simple way to understand the nature of its business is of a particular company which you have selected is to visit its website and get the desired information from the annual report of the firm, balance sheet and profit and loss statement, director's report, auditor's report, and so on. So you have done the initial screening, then you go to the website. From the website, you get the annual report of the firm, you get balance sheet, P&L, director's report, auditor's report. Select those companies for investment whose products and services will be used in the long term, say over 20 years. Now, this is drawing an input from Warren Buffett. But I will say not over 20 years, but which should have a business for at least the next 7 to 10 years. Even if I don't go for 20 years, at least for the next 7 to 10 years, it should have a business. So select those companies where you think the business will still be there, valid for the next 7 to 10 years. You see, in the case of my company, first investment in HDFC Limited, I invested in a company which would be there for generations, without knowing anything about fundamental analysis. All that I knew is that I needed a flat, I needed a roof over my head, and irrespective of what happens, people in this country with a growing population will continue to need a roof over their head. Okay, so you can say it is a gut feeling. Okay, gut feeling is also good enough. Okay. Check for future prospects, new products, expansion possibilities, statements on business strategy. Okay. Check for changes in ownership and management. So this is a quick checklist in order to enable you to shortlist the company. Okay. Now we are ready to move to the next set of slides. Yeah. Give me a couple of minutes, a minute or two. I will just go to the next set.
Sir,
Yeah.
there
Yes.
are a few questions there
Okay.
in the
Okay. Okay.
chat box.
Okay. Let me address
So
the questions. Let me address the questions. Yeah.
yeah, if you want, you can address the questions now or
No. 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 I will
later
do it
as
now.
well.
I will do it now. Yes. Yes.
So Binayak Modak is asking that is it not important to calculate my profit and loss when I am investing? Uh, I'm not
Whether it is important to calculate my
my profit and loss, which
my
is
profit.
basically
Uh,
in from the investor's perspective. I think Binayak wants to ask that probably I'll be doing fundamental analysis, but at the same time, not just the companies, will I not be also calculating or assuming my profit and loss as well when I invest in that company?
yeah. Yeah. Sure. Sure. Yeah. Yeah. Let me answer that. Absolutely. You're right, Vinayak. See, uh, your calculation of profit and loss when you make the investment will depend upon to what extent your expectations from that company have been fulfilled. Okay. Now, when you are making that investment, you are expecting a certain dividend. You are expecting that the share price will rise by a certain amount in the next 4 to 5 years' time, right? Yes, that is what your expectation is. Okay. And you are looking at what is your opportunity cost. In other words, if I did not make this investment in that stock and I invested it, let us say, in some other financial instrument, like say, let us say a fixed deposit, and on that fixed deposit, I had the possibility of earning maybe 7 or 8% interest and the safety of the principal. That is my opportunity. Now I'm foregoing that opportunity and I'm investing in a stock share of a company where I'm expecting that I will get X amount of dividend every year. And at, let us say, at the end of 5 years, if that is my time horizon, at the end of 5 years, if I've invested 100 rupees, I should be getting 150 rupees for the investment I have made initially. So I have got a capital gain of 50 rupees, plus I have got the dividends in the respective years. Okay. And if I add up all this, will it be more than the opportunity cost of investing in the fixed deposit and getting 7 or 8% interest of that on the same amount of investment? So I will obviously try to look at a calculation like this. It is the back of envelope calculation. But the whole thing will your estimate of profit and loss, personal estimate of profit and loss, will depend very much on the projections of what you are going to get from that share, the projection of the dividend, the projection of the capital appreciation. Those are projections, no?
Okay, I think that explains very well about the investor's mindset. Uh, then Swati Raj is asking, sir, when you are saying a company is dominant, what do you mean by that? You have discussed about the company's dominance in the industry space and areas of
Yeah, yeah. When the company is prominent,
dominant company.
dominant. Okay, dominant.
Dominant.
Yeah, yeah. See, the dominance is. Let us go by. All of you should know. People who have gone through an MBA program, at least, should know. Dominance is defined in can be described in terms of, let us say, market share. In my area, in my area of goods and services, I am a dominant company. That means I am holding, let us say, more than 50% market share. Is Maruti Udyog, is the Maruti automobile, isn't it dominant? I think it has got 52% or 53% or something market share in the passenger car industry. It is dominant, surely, from market share consideration. The second part of it will be it can be dominant in terms of, let us say, features like in innovation, in terms of technology. It can be dominant in terms of its export potential. So when you are talking about dominance of a company, you will have to see dominance from different perspectives. Today, definitely you'll say let us say Reliance Industries, within Reliance Industries, Reliance Jio, which is the telecom wing of Reliance Industries, it has not been separated out as a separate company yet. Okay, but it is very much a business within Reliance Industries. Isn't Reliance Jio considered to be dominant? Dominant by what characteristic? Dominant by way of market share in terms of number of subscribers? Yes. In terms of it is able to set the agenda for pricing. What other people will price their products at in the telecom area will be determined to a large extent by the price which Reliance will fix, because they are the lowest cost producer in this industry for this. So the dominance is coming from that angle as well. And then it is a matter of technology and infrastructure, the type of backbone infrastructure which Reliance Jio has laid. I think none of these other competitors of theirs can match that infrastructure, the digital infrastructure. So, Swati, I hope I'll be able to explain to you that the dominance of a company has to be seen from multiple aspects.
Okay, Shati, I think that very nicely explains the company dominance. Rohit Kumar Mukherjee is asking, you had mentioned, sir, earlier about financial and non-financial aspects while reading the numbers for the companies. Now, Rohit is asking, do these non-financial aspects also include the CSR activities that the company does?
Okay, let me put it this way. Uh, See, CSR activities is something which is now mandated by the Ministry of Company Affairs. You see, many companies were doing CSR on their own without being told to do so. The Tata Group has been doing CSR for years and decades together. The House of Birlas also has been doing CSR for decades together without being told to do so. Okay. Now, here is something where CSR has come in the form of a regulation, a statutory requirement that 2% of your net profits you have to invest in CSR activities. So you are being mandated, right? Now, fair enough, you are mandated. This is some socio-economic activities in which a company, as a corporate citizen in society, it must lend its hand. I agree. But CSR cannot be said to be one of the vital non-financial aspects of the company. It cannot be said. The vital non-financial aspects of the company are those which are critical to the functioning of the company. You see, the nature of the top management, the quality of the promoters, your USP, okay, the competitive, the core competencies which you have, okay, now those are vital for the functioning of your company, for the success of your business, okay. But CSR cannot be considered to be a vital factor, which is non-financial, of course, a vital factor for the success of the industry. It is something which is now mandated, but those, even in the days when it was not mandated, it was something which you are doing it as a responsible corporate citizen. But I will say this: what is vital for non-financial aspect of the company is corporate governance. Corporate governance means that you are ethical, you take care of the shareholders, you do not try to use the position of trust. You are in a fiduciary, management is in a fiduciary position. That means you are a person on whom a certain trust has been bestowed. You do not use that trust which has been bestowed on you to take undue advantage for yourself. So I would say corporate governance is one of corporate governance. Your adherence to ethical standards, your ability to take care of your investors in a proper manner so that you do not cheat them. Those are vital aspects of vital non-financial aspects of the company.
Okay. So I have only one more question in the chat box. Uh, it's a little more specific than the discussion that is going on here. Shushobhan Shen wants you to discuss about Tesla, as big public figures have already invested in it. Is it a good investment to invest in Tesla, and can investors from India buy the Tesla shares? It is a little more specific than okay, if you
Okay.
want,
Yeah,
please.
yeah. No, to the extent that I can, let me. But okay, number one is that yes, I think people from India, subject to certain limits of the RBI for overseas investments, investors from India can participate in the buying of foreign shares, and that includes buying shares in Tesla. Okay, maybe it is going through the Nasdaq or whatever is the appropriate stock market, stock exchange in the US, but you can buy shares of Tesla, and you are permitted to invest up to a certain amount of rupees as per the laws given by Reserve Bank of India. Okay, that is one. The second, you can go through one of the standard broking houses. You can go to maybe through HDFC Bank, ICICI Bank. They will guide you on the matter. Okay, for foreign investment in shares. So far as what is whether Tesla is a good buy, if you ask my personal opinion, I think Tesla is a very good buy.
That's actually great. It's really into an industry which is coming up really, really well. The electric vehicle, sustainable energy usage in the transportation industry. And Tesla does have a dominant position there. And as Sir has mentioned, uh, depending on the guidance given by RBI, depending on some limits set by RBI, yes, Indian citizens are also allowed to make overseas investment. There are many avenues through which you can do that, like Sir was saying, through some brokerage houses that allow you to invest into the foreign capital markets. Other than that, there are also certain funds that have come up. These are other kind of financial instruments through which you can also have a basket of different overseas stocks. Some of the fund houses have come up recently with such baskets. You can do that as well. Okay.
Yeah.
Shoham Majumdar is talking about investing on crypto. A little off the topic here, Shoham, but definitely as part of our ongoing discussions, we will discuss about crypto also.
This crypto money, this KRIBCO.
No. Cryptocurrencies.
It's
Oh,
like
cryptocurrency.
Cryptocurrencies.
Cryptocurrencies. Okay, investing in cryptocurrencies is it is a little we are digressing because we are focused on stock markets. We are focused on shares. Now, cryptocurrency is which is basically currency investing. Just like we have investments in foreign currency and all that. That is also one of the ways of investing and earning a return. So investing in cryptocurrency is also one of those. But at this moment, let me be honest, I do not know too much. I don't know enough about investment in cryptocurrency. I don't know enough about it. But but one thing is sure is that uh, it is something. mm, you see, I will go back to what Warren Buffett said. Do not invest in anything which you do not understand. I do not understand this. Okay. So I will not be the right person to advise you on investing in cryptocurrency.
Okay, this one is actually coming up definitely in a very fast manner since the uh, initial papers have come out on cryptocurrency versus fiat currency. And I'm sure there will be a lot more enthusiasts there as part of our finance club agenda. Uh, I promise you will have a discussion on cryptocurrency some other time. Let's stick to the stock market for this webinar. Okay. All right, sir. I think that's all that is there in the chat box for questions so far. So
Okay.
you may go to your next topic.
Next. Okay. Okay. Okay.
And I just added with the our principal sir. So definitely we will do that. Basically, I working in the farm where the farmers basically traded in the cryptocurrency. I am also traded in cryptocurrency. So I will arrange these things.
Yes, I also have a keen interest in that. I also am an investor in cryptocurrency, so I can take part in that particular session also.
Okay, sir.
Okay.
Great.
Okay. Mm. Is the screen visible?
No, sir.
Hello?
No, sir.
Screen is not visible?
You
No,
have
sir.
started sharing. You have started sharing, but still the screen has
Okay.
not come up.
Okay. Okay. Okay.
Sir, you just first stop the screen sharing, and again you share it, and after that select your PPT and share. You just put it the button of share button. Yes. Yes, sir. Now it is
Now it
visible.
is coming?
Yes, sir.
Yeah?
Yes, sir.
You can see the screen now? Yeah.
Yes, sir.
Okay. So having done that, the basics, we have understood the basics which are involved in fundamental analysis. We are now coming to the final round, final lap, which is estimation of the intrinsic value of the share. Okay, the share which we have identified by that kind of a detailed analysis which we have seen in the earlier discussion, we have now zeroed in on that company, and we are interested to find out what is the intrinsic value of the share. Okay, now again I'm starting this presentation, this part of the presentation, with this famous quotation by Warren Buffett: price is what you pay, value is what you get. Okay, now, the whole strategy of Warren Buffett has been to identify those stocks which had a certain intrinsic value, which was higher than what the price was prevailing in the market. Okay, and his strategy has been, you buy those shares of companies whose prices today are ruling lower than what the intrinsic value should be. Okay, so you go and invest in those shares. That has been the strategy of Warren Buffett. So he used to establish the intrinsic value, and then he used to look around for those companies whose shares were, obviously in that particular industry and all, whose shares were below that intrinsic value. And then he invested heavily in that, and he waited for 5 years, 6 years, 7 years, until they came up to the intrinsic value, at which time he took a call whether to exit or to continue. So this is what he says: the price is what you pay and value is what you get. If you wait reasonably long, you will get that value, but the price is what you pay today, the price may be lower. Okay, so what is this word intrinsic means? I thought it is worthwhile to recapitulate very briefly. Intrinsic means the essential nature of something which is inherent, innate, deep rooted. Something which is the essence of that thing. Okay, so intrinsic means the essence of that share, the market price, that essence. What is that? What is that figure which should be? Which should reflect the price which you should pay for that share. The essence, the deep rooted, inherent, deep, innate, like that. Second thing to appreciate is there is no universal standard for calculating intrinsic value of a share. There is no standard technique. Okay, there are multiple techniques, and they will give you a value which is in a range. Okay, there is no exact value of an intrinsic value of a share. Okay, and all these calculations are subject to various assumptions. Okay, that is why it is, we must be careful that if we are working out intrinsic value, the intrinsic value should be for different scenarios, and that is what we shall talk about shortly. One of the well-known treatments, techniques for working out intrinsic value, the same thing which has been used by Warren Buffett also, uh, as a part of his way of finding out what is the intrinsic value, is the discounted cash flow technique. Okay, now for those of you who are not into accounting, not into finance, there is no need to be apprehensive. We will discuss this in a very, very simple manner, but we are trying to give you an appreciation of what this discounted cash flow technique is all about. Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. It is the discounted value of the cash that can be taken out of a business during its remaining life. So, what is this cash? And we are using the word free cash flow. Now, cash, as we have discussed earlier, is the net profit or profit after tax, to which the non-cash expenses have been added back. Okay, the non-cash expenses being depreciation and amortization. So that becomes the cash flow. PAT plus non-cash expenses like depreciation, amortization becomes cash flow. But then what is free cash flow? We are talking about free cash flow here. Okay. So from the cash flow, if you then allow for deductions due to capital expenditure which the company may be incurring, from the cash flow, you have spent so much money on buying new plant and machinery, or starting a new factory building. From that free cash flow, you make adjustments for any increase in working capital which is required by you to conduct the business. Okay. So that also goes out of the cash flow. So cash flow minus capital expenditure on buildings, plant and machinery, etc., minus increase in working capital which is required for you in a growing business. If you deduct these two things from the cash flow, you get free cash flow. Okay, you get free cash flow. That is net of increase in working capital and net of capital expenditure. So you get free cash flows. Okay. Now these free cash flows are estimated year by year for a period between, let us say, 5 years to 10 years. First year, second year, third year, fourth year, fifth year, and beyond that, 6th, 7th, 8th, 9th, 10th, like that. Or you may stop at 5 years only. Okay. So every year you work out the free cash flow. Now, you'll see here, there is a very important parameter here, discount rate. What is this discount rate? Okay. Now, this brings me to a discussion on a concept of time value of money. Okay. Those of you who are not familiar with this concept of time value of money, suffice it to say, if I was to tell you that the value of 1 rupee today as compared to the value of 1 rupee tomorrow is the time value of money. If you had 1 rupee today with you, you could invest it and earn an interest on it. Yes, surely. So 1 rupee today would be equal to 1 plus the interest earned on that 1 rupee at the end of 1 year. So let us say 1 rupee is equal to 1.10 at the end of 1 year. So 1.10 is equal to 1 rupee today. Okay. Because if you had the 1 rupee, you could earn a 10% interest on that by investing it in a bank. And at the end of 1 year, you will have 1.1 rupee. Number two, the goods and services which you can purchase with 1 rupee will be more than what you can purchase with that 1 rupee after 1 year. Why? Because by that time, maybe there is 7%, 8% inflation in the economy. If there is 7%, 8% inflation in the economy, the same goods which you could have purchased at X, you will not be able to purchase it at X. You will have to pay more to buy the same amount of goods at the end of 1 year because the prices have risen. Right? So I'm giving you two very simple examples where the time value of money comes into the picture. 1 rupee today is equal to 1.10 rupee tomorrow, or that 1.10 rupee at the end of 1 year is equal to 1 rupee today. Right? At what you can purchase for maybe 1.10, now I could have purchased at 1 rupee today. So what does it mean? It means that the cash which I am going to get at the end of year 1, at the end of year 2, at the end of year 3. Now, if I was to convert those cash into what they will be equal to today, I will have to do what is called discount them. If I have to convert that 1.1 rupee at the end of 1 year to the 1 rupee today, I have to discount it. If I have to convert that 1 point whatever at the end of 2 years to what it is today, I have to discount it. Okay. And at the end of third year, whatever it is there, if I have to bring it to what it is should be equal to today, I have to discount it. So this is the concept of discounting which comes from the concept of time value of money. Okay. Now the question arises, what should be the discount rate? What should be the discount rate? The discount rate, as we shall see, should be what is the investor's expectation of investing the money and earning a return. What is the return that the investor is expecting? What is the required rate of return of the investor? What is the opportunity cost of the investor? If I did not do this, I would have done something else and I would have earned a return on that. Therefore, any earning which I get at the end of 1 year, 2 years, 3 years, and so on, I I have an expected return, and the expected return rate will be the rate at which I will discount the future cash flows. Okay. So if I was to discount the future cash flows at the discount rate, I will get the present value of a stream of cash flows, the present value of the cash flow at the end of 1 year, the present value of the cash flow at the end of second year, the present value of the cash flow at the end of third year. All that today, if I bring them here and I add them all up, that will be the value of that will be the value of the business. That will be the value of the business. Because what we have said, the cash flows which that business is generating, if I bring all those cash flows to the present, that will be the value of the business. Value of the business, mind you. Yeah. Okay. So now let us see whatever I've explained to you, let us see in the subsequent slide. What it will mean is these free cash flows, I am discounting it. When I'm discounting it, means I divide it by 1 plus R, the discount rate. Second year, 1 plus R to the power of 2. 1 plus R to the power of n. Now, you'll see here, there's a term which is called terminal value. Terminal value. Now, I will explain this terminal value, just to bear with me. Now, any business has got a certain life. Okay. It may have a life of, let us say, 20 years, 30 years. It may have a life even longer than that. Okay. Now, we are in a position to make a forecast of the cash flow, maybe for the first year, maybe for the second year, maybe third year, fourth year, and fifth year. Let us say by all kinds of judgment, you can say any techniques of forecasting demand, my share of the demand, all those calculations I do, I can forecast maybe what is going to be my cash flow in the fifth year, first year, second year, third year, fourth year, and fifth year. After that, I I may feel that I am not in a position to make any more year specific cash flows. But I may make an assumption that from after the fifth year onwards, the cash flows will grow at the rate of 5% every year. That kind of an assumption I can make. Or I can make an assumption that after the fifth year, the cash flows will decline by 2% every year after the fifth year. So that increasing or decreasing, I say that I call it a factor G, the growth rate or the decline rate of the cash flow beyond the fifth year for an indefinite period. For an indefinite period, because the business will not shut down tomorrow. The business will not shut down at the end of the fifth year. The business will continue after the fifth year. Only thing, I'm not able to forecast the exact cash flow in the sixth year, seventh year and all, but I'm making a simplifying assumption that after the fifth year, the business will continue to grow at 5% or the business will decline at the rate of 2% indefinitely. Okay, correct? So now the question arises that for those cash flows which are taking place beyond the fifth year, mind you, what will be the present value of those cash flows at the end of the fifth year? The cash flows which are taking place year by year after the fifth year, if I was to bring those cash flows to the end of the fifth year, what will be the value of those cash flows? That is the figure which we are talking about, is the terminal value. So if we are taking a time horizon of 5 years and the cash flows are taking place beyond the 5 years, which we are not able to predict or forecast, but we are able to make an assumption, make a simplifying assumption that the cash flows beyond the fifth year will grow at 5%, 6%, 3%, 4%, whatever it is. Then for those in cash flows which are going indefinitely beyond the fifth year, what is the present value of the cash flows if I brought them to the end of the fifth year? That is this terminal value. I will come back to this slide, but let me quickly go to terminal value. This terminal value, which we are calling here, is given by the free cash flows at the end of the fifth year, and nth year, let us say, is the fifth year, into 1 plus G. G is my assumed growth rate in the cash flow beyond the fifth year, divided by R minus G, where R is the expected discount rate, the expected rate of return required by the investor, which is the discount rate, which we are calling the discount rate, minus the growth in the cash flow, annual growth rate in the cash flow beyond the fifth year. So the terminal value of cash flows beyond the fifth year at the end of the fifth year is given by free cash flows in the fifth year into 1 plus G divided by R, which is the investment rate required by the investor, minus G. Okay, so this is what is the terminal value. Now this terminal value which you are seeing here is there at the end of the fifth year. Okay, for cash flows beyond the fifth year. But in addition to that, there is a cash flow in the fifth year itself which has to be discounted. There is a cash flow in the fifth year itself which has to be discounted, brought to the present. So the intrinsic value of the business is made up of free cash flows in the first year discounted to the present, so R to the power of 1, and the end of second year discounted to the present to the power of 2 because it is second year. Third year will be power of 3. At the end of nth year, it will be 1 plus R to the n. That means in the nth year, cash flow, bring it to the present, free cash flows, nth divided by 1 plus R to the n, plus at the end of the fifth year, we have the present value of the cash flows for period beyond the fifth year, which we are calling the terminal value. So that now, since that terminal value is also at the end of the fifth year, we have to bring it to the present. So terminal value divided by 1 plus R to the power of n. So the terminal value also we are bringing to the present. So the sum total of all this becomes the intrinsic value of the business. Okay. Now, if this becomes my intrinsic value of the business, I want to find out what is the intrinsic value of the stock. So the intrinsic value of the business divided by the total number of outstanding shares becomes my intrinsic value per share. So if I divide the intrinsic value of the business by the total number of outstanding shares, I come to the intrinsic value of the share. Yes? Now, the same thing which I have explained just now, it is there in the discussed also in this slide here. We can just have a quick look. What is the meaning of cash flows? Net profit plus non-cash expenses. What is free cash flows? Cash flow minus capital expenditure plus minus working capital. What is the discount rate? Is the required rate of return of the investor, taking the riskiness of the firm's business into account. The required rate of return of the investor for investing in that company, taking the riskiness of the firm's business into account. Now, not every firm has that same degree of risk. Now, the degree of risk of a firm is given by what is called a parameter called beta. Now, we need not get into these concepts of beta and all at this stage. This is not the level for a lay person to understand. Suffice it to say that the required rate of the return of the investor will depend upon the riskiness of the firm into which he is investing. So if the firm is more risky, he will require a higher return. If the firm is less risky, he will require a lesser return. That is something which you need to appreciate. If the investor is investing in a firm which has got a higher risk, I will expect a higher rate of return because I'm taking a higher risk. Therefore, I want to have a higher return. If if I'm investing in a company which is a lower risk firm, riskiness of the firm is lower, then I can expect a lower rate of return. That is the important thing you must take away. And the other concept which you may take away also is that the riskiness of a firm is given by its beta. Now, what is beta and all? Let us not get into that. It is too premature for us to get into it. But you can only appreciate that the riskiness of a firm is given by its beta. And the higher the riskiness of the firm, the higher is the required return expected by the investor. Lower the riskiness of the firm, lower is the return expected by the investor. So what it means is that in this R, for a more risky firm, the R will be higher. For a lesser risky firm, the R will be lower. Yeah? Okay. So the discounted cash flow technique has this is the way that ultimately I will work out the intrinsic value of the stock. So what is important? The cash flow forecast becomes very, very important. Step 1, forecast of the expected earnings and cash flow. Most crucial, I have historical data. I have the historical last 5 years, 7 years data on cash flows year by year I have got. But should I project it forward? And if I should project it forward, I should project it forward at what rate of growth? Or there are certain unique things which are going to happen, which I have now understood is going to happen in industry, and I do not want to project my past data, past cash flow, and make it grow by 5 years or so. I have to modify my cash flows in the future by the developments which are taking place in the industry and in that company. So I hope you are able to appreciate that we are getting into now assumptions which we have to make in order to forecast cash flows in the future. I can take the help of past data, but I should not entirely be dependent on the data. I should be able to modify that data to suit what is happening in the years to come. Okay. So we say here, a good estimate is based on a careful projection of revenues and costs, which in turn are based on certain assumptions. As there are many uncertainties in future, it is usual to prepare cash flow forecasts for different scenarios. That means there is a set of assumptions and based on which I'm making the cash flow forecast for the next year and the year thereafter and the year thereafter. Okay. And maybe there is another set of assumptions on based on which I'm making the forecast for again the year 1, year 2, and year 3. And we call each of these estimates for forecasts as different scenarios. So there can be 3 scenarios of the forecasted earnings: based a pessimistic scenario, a reasonable scenario, or an optimistic scenario. And each of these scenarios is based on a set of assumptions. And what are these assumptions? These assumptions pertain to demand growth, how the demand is going to grow, what is going to be my company's market share, will it change, what will it become, what will be the sales growth, will there be a change in my product prices, will there be a change in my raw material prices, will there be a change in the interest rates from banks? Now these are simply examples of the type of assumptions under which there can be a scenario 1 pessimistic, a scenario 2 reasonable, and scenario 3 optimistic. And for each of these scenarios there will be a cash flow year 1, year 2, year 3, year 4, year 5 for each of these scenarios. Right? So if I am to work out the intrinsic value of the share by the discounted cash flow technique, then these cash flow forecasts will have to be there, and I will have to discount them by a expected rate of return. So the second step will be the selection of the rate of return, and the selection of this discount rate of return is something which has to take into account the riskiness of the firm, right? So at this moment, I I'm simply going to show you one of the ways to calculate the expected rate of return. I am not expecting you to go into the intricacies and details of that. That would be too much for a person, initial, a layman to get into at this stage. But at least an awareness will be there that there is a method to calculate the expected rate of return, at which you must discount the cash flows, because I have to select this discount rate. I have to select this discount rate, and the selection of the discount rate, there are different ways to select the discount rate. So I want to just only expose you to that there are different ways. At this moment, it's not necessary to get into the details of that. That can be done by a person who wants to pursue this in a slightly more advanced manner. But there is a discount rate. Okay. And there are also simple discount ways of discounting, which we shall look at, and we shall use them in the case analysis on the day after tomorrow. But let us see selection and calculation of discount rates. And having done that, then how I discount the cash flows and come to uh, uh, the intrinsic value. Now, just wait 1 minute. Yeah, yeah, yeah. Okay. And using them, I'm come to the intrinsic value using the formula. Now, if the intrinsic value, let us say, if I calculate the intrinsic value as this, and the market price is 100, then what do I see? I see that the market is overvalued. The market is overvalued. Intrinsic value is lower, but the market is overvalued. In other words, if there will be in other words, what is happening is that inherently the share price is only 90, but the market is overpricing it. So if I'm holding that share, I should get out of the market, because the inherent value of the share is not 100, the inherent value is the 90 only. Okay. So if I'm holding the share, I should exit. Alternatively, if I'm thinking of investing in that, I should not buy that share in the market, because the market price is 100, the inherent value is only 90. I should not buy the share. And if I have the share, I should sell out, and because the 10 rupees is the amount of overvaluation of the share. That will be the type of decision which I'll take. Okay. Now, so this is the basic way. This is the basic way of using the discounted cash flow technique. Now, besides the discounted cash flow technique, one of the very, very popular techniques is the price earnings ratio technique. Okay. And what is this price earnings ratio technique? Step one remains same as we have done in the first thing. Only thing here, I am not having cash flows over 1 year, 2 year, 3 year, 4 years, 5 years like that. Okay, because I'm not going to what I'm going to have is here is what is my earning in the next year. What is my earning in the next year? Because I'm trying to decide whether I should invest, let us say, whether I should invest in the stock. So let me look at the earning. What is the earning expected in the next year? So out of that forecast, I take the earning in the first, out of that first 1 to 5 years, the earning in the first year. Let me take that. Okay. As the first step. Second step, establish a PE ratio. a price earnings ratio. You recall we have discussed the market price of the share divided by earnings per share when we are discussing the ratios connected with the balance sheet discussion. The price earnings ratio reflects the price investors are willing to pay per rupee of earnings per share. It represents the market's valuation of the company's prospects. There are different PE ratios for the same stock, like a PE ratio based on last year's earnings. So what is the price I take? Okay, I may take today's market price divided by last year's earnings. I may take today's price based on current year's expected earnings. I may take the price divided by uh, 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 the following years, the price today divided by the following year's earnings. So there are different ways in which this price earnings ratio is calculated. But the one which is most popularly handled is the P ratio based on the current year's earnings. That means this is the price prevailing today based on the current year's earnings. Now I want to take a decision to invest in the stock either at present or in the coming year or in the coming year. Okay, so in that case, what are the approaches which are available to me? One approach is what is called the constant dividend growth model. Another is the historical analysis. Other is the cross-section model. Now, this constant dividend growth model is widely used in forecasting the P ratio in the following year. Okay, or what should be the P ratio in the current year. Okay, now this P ratio is given by this formula which you see here. Let us not get into how this formula has been derived. Okay, but let us only appreciate that the P ratio, if I have to arrive at for the current year, I will arrive at by this method, which is, as you can see here, all the terms here are terms we have discussed. Dividend payout ratio, that means what is the total amount of dividend paid out of the after tax profits. DP ratio, we call it. We talked about, we showed this in the ratios we saw after the discussion on the balance sheet. Divided by, in brackets, required return on equity, required return on equity. That means this is what the return the investor is expecting, minus expected growth rate in dividends. That if the dividends are getting declared, what is the growth in dividends which is taking place or which is expected to take place year to year? What is the growth rate in the dividends? G. Okay. Now, so this is clear. Now, so dividend payout ratio, dividend paid divided by PAT, and what is G? How do I calculate G? G is calculated by 1 minus the dividend payout ratio into return on equity. Now we know what is return on equity. We have seen that in earlier discussions. Okay. Dividend payout ratio also we have seen. Therefore, this G, which we are calculating, is 1 minus the DP ratio into the return on equity. Okay. Now, let us not go into the derivation of this G is equal to this, and this. Okay. Suffice it to say that there are calculations which back up the parameters which I'm saying. Okay. At this stage, I'm looking for only appreciation. Okay. So these are the parameters which go into the calculation of the P ratio. And then finally, there is the expected required return on equity. The required return on equity is again a matter of derivation, which you need not get into, which is given by risk-free return. The risk-free return is the interest rate which is charged on government bonds, treasury bills. That means which are risk-free, where there is no risk at all. That if you invest in the bonds of the central government, you will definitely get the interest every year, and definitely the amount you have invested will return to you. So it is a risk-free investment. So the return on a risk-free investment like a government bond, central government bond, is the first item, plus beta of the equity. That means what is the riskiness of that share is given by its beta. Okay. Suffice it to say that this beta is calculated in some way. We need not go into it, but the riskiness of the firm is given by its beta. Riskiness of the share is given by its beta. into market risk premium. Market risk premium is the return on the market. That means what is the return which, let us say, the Sensex, all the shares which are there in the Sensex, what is the return the Sensex is giving you, yeah, year to year, minus the risk-free return. Okay, that is the market risk premium. What is the return? The total basket of shares which is represented in the index, in the Sensex or in the Nifty, minus the risk-free return, which is the same as this one. That is the market risk premium. So using these parameters, we calculate what is the required rate of return for the investor. Okay, so it is a little involved here. I do not expect you to go into the details of this. Suffice it to say that there is a method to work out under the constant dividend growth model what should be the P ratio. And let me tell you, this is widely used also. This method is widely used also for people who are financial analysts and security analysts. They widely use this method. Simpler methods, which we will adopt, and we'll adopt that for the case study tomorrow, on the day after tomorrow. Simpler methods are historical analysis. The average P ratio of the last 3 years may be taken as applicable in the immediate future as well. But strictly speaking, it has to take into account the changes in the future business conditions of the firm. Strictly speaking, I must modify this, but for simplicity's sake, there is a tendency that if I have the last 3 years P ratios, take the average of the last 3 years P ratios and use it for projecting the P ratio in the coming year as well. You have another method, a cross-section analysis, where the P ratios of similar firms, just like my company, you have a similar company, okay, operating in the same industry. The P ratio of similar firms in the industry can be examined, and a reasonable P ratio adopted for the subject firm. So you have seen a variety of P ratios for the different firms in the industry, and out of that you use your judgment to select a P ratio, taking this cross section of firms into account, the P ratios of the cross section of firms into account. And finally, you have a third one, which is nothing but a simple average or a weighted average, that is up to you, average of the above methods. What are the above methods? Cross section analysis, historic analysis, constant dividend growth model. So you can take an average of the P ratios which you have put down from these three models. So having taken this P ratio, we come to the third step, intrinsic value and the value range. So intrinsic value is given by the projected EPS. Okay, projected EPS, mind you, we have to, the year is there, we have to go, we are going talking about the next year. What is the growth rate in the next year? Based on that growth rate, what will be the sales, what will be the net profits, and what will be the earnings per share? That is the projected EPS. So for that projected EPS, if I multiply it by the P ratio I have selected in the previous step, I get the intrinsic value of the share. So the projected EPS in the coming year multiplied by the P ratio which I want to take forward. Okay, so projected EPS multiplied by the P ratio will give me the market price per share. That market price per share is the intrinsic value of the share. So as valuation is an imprecise exercise, it would not be right to depend upon a single figure. Hence, the valuation may be done for the EPS projected under pessimistic, reasonable, and optimistic assumptions. And an intrinsic value range arrived at, say, hypothetically, by looking at the intrinsic value calculated under pessimistic, optimistic, and reasonable scenarios, we come to a range for the share, which is rupees 30 to rupees 38 per share. This is the intrinsic value of the share, subject to these different scenarios, subject to the assumptions we have made, and we have, having done all that, we are arriving at this type of thing under the P ratio. We are talking about the P ratio technique. Okay, so we say if market price is less than 30, the market price actually ruling in the market is less than 30, you buy. Why you buy? Because the intrinsic value I have projected is between 30 to 38. The intrinsic value is higher and the market price is lower than 30. So in course of time, the 30 will rise to the intrinsic value. So if I buy the share now at 30, I will be rewarded tomorrow by the price increasing to the intrinsic value. So if it is market price is lower than the intrinsic value range, then I buy the share. If the market price is more than 38, which is the higher bound of the range, then and I'm holding the share, then the signal is very clear that the share is trading at a value at a price which is more than its value, so I should sell and get out of it. And if the market price is between 30 and 38, you consider holding the share. Okay. So this is basically the approach of the P technique. One more technique I just wanted to share again as an awareness level, at the level of awareness, is that of Benjamin Graham's formula. Benjamin Graham is a guru, investment guru, who wrote The Intelligent Investor. He is coming before Warren Buffett. He comes before Warren Buffett in terms of the timeline. First there was Benjamin Graham, and then there was Warren Buffett. Okay. So Warren Buffett is the author of the very famous book, The Intelligent Investor, and he is known as the father of value investing. And he has prescribed a formula for calculating the intrinsic value. This formula was prescribed for the US markets, but it has been modified for the Indian markets. And it is given by what you see here. Intrinsic value is the earnings per share into 8.5 plus 2. Let us not get into the details of how this calculation was done and how this formula was arrived at, plus 2G into 8.5 divided by Y. What is G? The future growth rate in earnings over next 5 to 10 years. What is the growth rate in your PAT over the next 5 to 10 years? G. And what is Y? Y is the interest rate of AAA rated corporate bonds in India. That means which are very, very safe, risk free, almost risk free. The interest rate on such bonds, corporate bonds, not government bonds, corporate bonds in India, that is Y. So if you use this, you arrive at the intrinsic value of the share as per Benjamin Graham. Okay. So we have looked at the three techniques: the discounted cash flow technique, the P technique, and the Benjamin Graham's technique. So if the intrinsic value of a company is given uh, like this, year to year, we calculate the intrinsic value of the company. It is like this, and the market price of the share is happening like this, then I should buy. This is the buy zone, because if it is already at such a low price and the intrinsic value is already so high, okay, is already so high, but the intrinsic value is subject to so many assumptions, so many variations. I can go wrong. The intrinsic value may not be this high. It may be at this level, or it may be at this level. So we say this is my margin of safety. So if the intrinsic value, which has been calculated with so many uncertainties, with so many assumptions, is still at this level, and the market price is at this level, there is a huge degree of safety, where even if the intrinsic value of a company calculation has gone wrong, I can come down, I can come down here, and still there is a margin of safety. So I would still be in the buying range. Okay, so that is Benjamin Graham's formula. So I hope I have taken you on a journey. I've been able to take you on a journey, exposing you to the issues and aspects of fundamental analysis, the whole purpose of which is ultimately to arrive at intrinsic value of a share. That intrinsic value of the share is subject to so many uncertainties and assumptions. Still, we use it to get an idea of how the market prices is compared to that intrinsic value of the share. And we use it for the purposes of taking a decision whether I should invest in that share or I should not invest in the share. So if the market price is significantly lower than the intrinsic value of the share, I would like to invest and wait for that share to reach its intrinsic value. And that is the capital appreciation I'm looking for. Okay. So thank you very much. Uh, I hope I have been able to at least sensitize you to the issues involved in fundamental analysis. So for the last part of the session, estimation of intrinsic value, if there are questions, I'll be happy to answer them.
Thank you, sir. What a nice presentation. You have totally described about the intrinsic value and other things. And Shohom Mojumdar asks, said, how to short a company stocks, how to cover my margin,
No, I didn't get the question.
how to short a company stocks, how
How to
to
short?
short. Short means sell. They mean they
How to
want to
short? Yeah, how to short? Now
how
you see, yeah, yeah. You see, the issue here is that one is the fundamental analysis approach, and the other is what you will hear tomorrow is in the technical analysis approach. Okay, when do you short? When do you short and how to short? Okay, now if I'm holding a share where the intrinsic value is higher than the market price, higher than the market price of the share, definitely I should get out of it. If my intrinsic value is higher than the market price of the share, higher than what that share should really be worth, then I should not be holding the share. I should be getting out of it. Okay, that is what I in my this thing I what I showed you, that if if the intrinsic value of the share is higher than the market price, I should think of buying the share, because the share will ultimately catch up with the intrinsic value. Market price will ultimately catch up with the intrinsic value. So at that time, I can think of booking a profit and getting out, or I may continue also. But your question is, when should I short? Short means I'm holding the share, the intrinsic value is higher than the market price. I'm holding the share. Oh, sorry, I'm holding the share. The market price is higher than the intrinsic value. The intrinsic value is lower. I'm holding the share at a price which is higher than the intrinsic value. Then there is no hope. There is no hope that the share price will go anywhere beyond. So I should get out of the. I should sell the share because the market price is higher than the intrinsic value. I should get out of it. So if the market price goes here in this range above this line, it goes here, I should get out of the. I should get out of that stock. I should sell off that stock.
actually said that where the said want to book their profit, they doesn't hold their position for a further long time because intrinsic value, the price will over to the intrinsic value because the share will help holding on the below the intrinsic value. Actually, I want to say. And another is Avid Shane, he says, very good session, sir. We can easily recollect what we had learned in the third semester in investment analysis, which will be quite beneficial in our future.
So is there a question or that is a statement?
No, sir, it's a statement.
Statement. Okay. Yeah.
And no more questions, sir. Principal, sir, can you say something about today's event?
Yes. Thank you, Professor Shobhato. Uh, Professor P.K. Bannerjee, I'm so much indebted. I was just mesmerized at the level at which you made the people understand all the basics of how to value and how to um, choose a company where you'd like to invest. I mean, Definitely, there will be more styles uh, other than value investing also, which are important. But you had given an excellent idea about what value investing is and how to pick stocks, pick up companies where there will be a probability of getting a long-term value out of it. I'm sure that all the listeners in today's webinar were also immensely benefited from this session. Uh, at least we are now familiar with all these terms, uh, how to gauge the companies, how to read the most important financial statements of the companies, how to assess a company and find its intrinsic value, and how to do, uh, I mean, selection for value investing. Some of the anecdotes I'll definitely take as a takeaway from this session, uh, like uh, when you are investing for the long, then do definitely research uh, the market and try to find companies for whom the business model, the operations, and the strategies you understand. Like jumping into a company just because it's the recent fad is not really the good one. You should be understanding the business, and then you will be able to make informed decision on that. Thanks for this wonderful session, Professor Banerjee.
Thank you very much. Thank you.
So on tomorrow on 10 a.m. We'll start our new session. That's the part of our technical analysis. So,
Thank
sir,
you, everyone.
thank you, sir.